Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to talk about home equity lines of credits, the difference between secured and unsecured, things to look out for, and some advantages of having a line of credit. If you're interested in a line of credit, let's go inside and talk a little bit more. Lines of credits. Many of you may have heard the term line of credit, home equity line of credit, or abbreviated to HELOC. What does it mean and how can this benefit you, or are you eligible to qualify for one? Thanks again for watching. We're going to talk about it, lines of credits and different ways and different things that you should know about a line of credit and if it's right for you. So first and foremost, lines of credits, two most common forms of line of credit are secured and unsecured. So a secured line of credit is something that is actually based on the equity of your home and is registered against the property. So you can't have a secured line of credit if you don't own a home. That would be an unsecured line of credit, which is something that is based on actual credit worthiness and your history with your credit. So the secured line of credit, which is also based on those components, credit, your income, as well as your ability in repayment, but it also bases more heavily on the equity in your home. How much can you leverage based on the value of your home? So if you own a home and you have a significant amount of equity in the home, then you may be qualified to actually get a line of credit. Maybe you have a line of credit against your home. Maybe it's time to revisit that line of credit and see if you can gain access to more money if you need it. So in this video, we're going to talk about the different components of a line of credit. So one thing that is important to understand about a secured line of credit, which is registered against your home, is first and foremost, are you eligible and what does it mean? So if you own a home, and let's say you have a home that's worth $1 million and your mortgage on it as $500,000, nothing would actually change with the mortgage component of it. That would stay the same depending on your amortization, depending on if you're restructuring or not. The line of credit component is separate. Now, some banks may register it as a second component in line with the first. They might do it as a collateral, an entire registration of one amount, which is broken up between the two. It can vary from bank to bank, lender to lender. So this is why talking to your mortgage professional, understanding these little nuances can come in handy. But generally speaking, the line of credit component is interest only. Right? So depending on the institution, the only minimum requirement that you have to pay on that is the interest component. Obviously, you can pay more. There's no penalties to pay more, unlike your mortgage, where if you were to pay more than the preset prepayment, you'd be charged the penalty. On the line of credit component, you're actually able to borrow the full amount and then pay it back at any given time. But in the drawn out period, you are required to pay at the minimum amount, depending on your contract, the interest only payment. So how does that basically work? So they're leveraging that money as a blanket amount that they say, hey, listen, this client is able to borrow this amount based on their credit and their income, and we're willing to give it to them at this specific rate. Now, generally, depending on your performance and your credit, which we talked about last week, you can apply for a line of credit if your lender actually has access. Now, there are a lot of banks, your charter banks will have access to a line of credit if you're banking with them. Some of the broker banks may or may not have that access to you, or maybe they're not eligible to give you that amount. Maybe you're looking for a little bit more. So talking to your mortgage professional will always be helpful in understanding where you are in the journey. But interest rates can vary, and they are based on the variable rate of the current situation, the current time. So as of right now, at the time of filming this video, the actual variable rate with most banks, or the prime lending rate, is 2.45%, and that's with most institutions. Now, the lines of credits generally come at a different price point. So you could be prime plus, you can be prime plus a quarter, plus 0.25%, plus 50 basis points, plus 75, or a full percent or more. So generally the range comes into play depending on institution, and looking to see where we can go with it with our clients will help them save some money as well. Now, lines of credits are something that we advise our clients very delicately on obtaining them, but they have been proven to be a very vital tool in the actual homeowner's package. So, for example, why do we say that? Well, having access to a line of credit can be dangerous for many people if you're not able to budget and you're not able to control spending. But if you're able to do that and you're looking to, let's say, buy a future home, or you're looking to buy an investment property, maybe do some renovations in your existing home, help your children through school, who have aging parents, maybe you're looking to retrofit their home to make the home more livable for them. There could be many different reasons why you're going to be looking at a line of credit. Because of the fact that they're cheaper than most credit cards and you don't necessarily have to take a cash advance and pay interest at a higher rate, lines of credit seem to be more attractive for a lot of people. But as I said, you need to be eligible to qualify for the line of credit, and that will be determined with your mortgage professional. Basically, when you look at the line of credit, we talked about the interest-only component of it. The amount that you're able to borrow against your line of credit can also change depending on the equity that you have in your home. And this is something that we like to touch upon, because if you're looking to just get a line of credit against your home, there's a few rules that the banks follow. So, is it basically an additional line of credit, which is up to 65% of the equity, or is it a refinance and restructure where you can go up to 80% and combine a larger line of credit with the mortgage component? Is a line of credit, does it close? How does it work? So if you have a mortgage with your bank and you have your mortgage and line of credit, as you pay down your mortgage, most of the line of credits will actually start to increase. As I mentioned to you, if let's say you had a $500,000 mortgage and you had a $200,000 line of credit, that's a total charge of $700,000. As you pay down that mortgage, you eventually will be left with a $700,000 line of credit. Now, for some of you, that may be a lot of money to look at, to actually have access to, but it actually helps clients in many different ways. Some of them may be looking to buy a cottage. Maybe that particular home that they're looking to buy is outside of the geographical lending area. Maybe it has some complications where you can't get the financing. Lines of credits can help the client purchase the home, go in there, do what needs to be done, or own the home right out. Another advantage, as I touched upon earlier, is getting a line of credit. If you have a line of credit and you're looking to make a move, planning accordingly, you can actually set up the deposit through the line of credit, which means if you're selling your home, you need to go out there and buy a home, you need to have a minimum, generally speaking, the rule of thumb is 5% as a deposit. Now, 5% in the current market is a significant amount of money, and having access to the line of credit to put that deposit down can help you securitize that home and maybe avoid having to reach out to friends and family for that money, because maybe you have access to it, maybe you don't. Also, if you're buying a pre-construction home, as opposed to taking all the equity out of the home in one shot, pre-construction homes that are maybe built are going to be built in a year to 2 years, 3 years, or 5 years from now, you only need to provide the builder with maybe 10 or 20% or maybe 5%, but it's going to be broken up in different structures. As opposed to taking out the money all in one shot and taking out in cash and paying interest from day one, you can use the line of credit to actually advance the money to the builder in its stages and only pay interest as the portion increases. So you're saving some money. And then if you sell the home, you can always restructure the line of credit. Line of credits are something that I personally use. I definitely see the lifeline that they can provide. If you have some unexpected costs that come down the road, as I said, owning a home is definitely fun. But there are always costs and things that need to be done, and having access to the money can be beneficial. One client pointed out a very good actual benefit to having a line of credit is, let's say you have an investment portfolio and that portfolio is doing very well. You can either leverage against the money that's in there, or you can take the money out, but you actually may be getting a better return on your investment portfolio than you would be just borrowing the line of credit at, let's say, 3%, because the return may be greater. So understanding the strategies of how a line of credit can help you are endless. I hope you guys found this video helpful. If anyone has any questions for that matter, and you need some clarification on if I'm eligible for a line of credit or if you can apply for one, please feel free to reach out to us at In Touch Mortgage Solutions. We're always here to help. I hope everyone has a great Friday and a great weekend ahead. Thanks for tuning in.